Congratulations on moving from personal fundamental analysis and your study on corporate fundamental analysis. Now we get to do sovereign fundamental analysis. This is a big picture idea. We're going to speak about countries, and this is a significant thing because these affect all these markets and more. I've got three main markets here. There's probably more than that, depending on how people want to categorize. But you have the debt market, which is basically loans. So we can raise money with debt. We can say, hey, I'm a corporation. Will you help me out? Would you buy a bond from me? And you could be a city and say, we'll even give you these tax-free. Or you could be like, for example, the U.S. Treasury has what they call T-bills or Treasury bonds. Or you could say, hey, I'll give you money, but I don't want a loan. I want a piece of the action. And so if someone says, look, I'll give you money, but I want to buy part of the entity here. So I want some common stock or preferred stock or private. This could be private or public. For example, I have many actually private companies where these are not for sale. There's millions of businesses that are not for sale. There's public companies where there's tens of thousands of businesses that are for sale, where you could buy a share of stock and own it. And then when we get into the third pillar of cash flow, we'll start talking about derivative markets, options, warrants, and stuff like that. And contracts can be public or private, no question about that. And so we'll get into some of those things. So you can do your country, whatever country you're from. We have students in over 100 countries that have taken the four pillars. And so whatever country you're from, it's fun to look at a fundamental analysis of your country because it can have an impact. Now, we don't care if it does well or poorly necessarily. We'd like everyone to do well. But when it comes to it, we want to be able to position ourselves to protect our own household. And so here we have those 8 numbers that I talked about that we'll look at in our own household. We can also do those 8 numbers for any country that we want. So let's hop out of theater mode if we can and move this over and let's do this. So here's the debt clock, and this will change always. One of the challenges we have when we record is the moment I shut this off, these numbers will obviously have changed. So it's fun. We like to do the recording because if I were to have to reteach this live, you wouldn't be able to review, you wouldn't be able to take a class over immediately. And so this is good stuff. So let's look at where these numbers are, and let's just do the U.S. and you can see where these are now. You can go and do this live in whatever time you're viewing it. But right here we have federal tax revenue, so I'll circle that right there. Nice. And we have federal spending, so we'll circle that one. Real nice. And we have a debt, which is going to be used, right? And we have a deficit. We have some assets, which are hilarious. And we have borrowed money over here. And we have a GDP right here. So those are the numbers to help you kind of pick them out a little bit. So we have a income here of 3.4 trillion. And we have a expenditures here of 4.4 trillion, which is about roughly $1 trillion right here. We'll just call it $1 trillion. We'll round it up. I mean, $995 billion and almost 996 billion and climbing. We won't be too far off to say we have negative $1 trillion here in a deficit. And if you'll notice that since this cupboard, we talked about all these as a cupboard. Since this box is now sufficient, we should be able to go to our asset box and now pay the balance of this with the asset box. Well, this is what's interesting about this asset box, and it'll bring up some interesting political things for you to think about and decide how you feel about them. But right now, they say that their assets, this is really strange, is who owns what. Let's say that here was you. This is an interesting way to think about it. And here's me. And let's say that you have your stuff, and maybe you have your stocks right here. Well, what if I said, no, 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 these are my stocks, and I put your stocks here? Would you have a problem with that? Well, that's exactly what the U.S. government does. They say, look, if we wanted to, we could tax these small businesses higher. We could tax these corporations higher. We could confiscate things that we think should be confiscated in household assets. So when you look at all the people, which is the biggest part, you look at the large corporations, which is the smallest part, and then the medium-sized corporations, which is the really smallest part. Biggest part is the people. So it's kind of interesting that people say, well, tax these corporations. Well, there's a lot more there in households than corporations. And these corporations and the small businesses are what help the household get their assets. But they might just say, look, we could confiscate this stuff. And they have before. They've said gold is illegal to own, believe it or not. And they say, we're going to take all the gold. Or we could take all the guns. Or we could take all this. We could say, if you think you own your house, that's an interesting concept if you believe you own your house. Because according to the government, they own your house. And there's some truth to that. All they have to do is say, we know we have a property tax for a municipality that you have to pay. Tell you what, we're going to do a federal housing tax. And whatever your house is worth, we're just going to take a chunk of it every year. Think about that the government at the municipal level takes taxes from your house, not based on how much you earn, but what the property's worth. And as your house appreciates, they just take a chunk of it every year, about 1% of what you have, they take every year. And as your property grows, they just keep taking their chunk to build your city. Well, the government could do that. The federal government can say, we're going to do that. And it was interesting because I have a neighbor who owns a flooring business. And all his guys were working on his house, redoing something. He says, I'm going to build a new porch off the front of my house. I want a different one. And it was about 2 feet closer towards the street than it was supposed to be. Instead of having like this big long area, it was big long area minus 2 feet. Didn't really matter. But the city came and said, nope, you can't do this porch. And he says, well, this is my house. I'm an American. I own this property. He says, no, you don't. It's ours. We have a city. You have to do what we say. So, who really owns real estate? If you think you own your real estate, stop paying property tax. Say, nah, it's mine. I think I'll just keep all mine. I'm not going to give you a piece of my house and pay you to live in your city. So it's kind of an interesting idea. So if they really owned this, why aren't they pulling it from here? Well, they're not, because people would freak out. So, are these their assets or your assets? Who knows? But we do know that the way they're paying this extra isn't with assets. The way they're paying it is by borrowing money. Probably because if they started doing it with, these assets, to take 22 trillion out of this would be significant money out of everybody's pocket. Of 115, if you took a fourth of that or fifth of that, took a fifth of everyone's wealth to pay it off, that'd probably bother people. So what they do is they borrow. And they borrowed a lot. They've borrowed 22 trillion, right here, 22.5, and they've promised 125 trillion over here in Medicaid, Medicare, other things that are unfunded. We talked about the difference between borrowing money and promising money. Promising money is a very difficult thing. It's happening on the local level. John Bogle had a great piece on this. He says it's a crisis, and it is. For example, Stockton, California went bankrupt. San Bernardino went bankrupt. Detroit went bankrupt. Why? Well, because of the money they promised, not the money they borrowed. In other words, they owed their firefighters and their policemen in those unions so much money that they couldn't collect enough property taxes to pay them. So they either had to raise property taxes beyond what people could do or were willing to do, or go bankrupt. They didn't have to go bankrupt. They could have risen the property taxes anytime they want. They probably just would have been voted out of office pretty quick, so who knows. But those are unfunded liabilities. Hostess, GM, United Airlines, Delta Airlines, same thing. They converted everyone to 401ks. That's why they went to bankruptcy, because bankruptcy allows you to break these promises, right? These promises. As soon as you go bankrupt, you don't have to keep your promises anymore. So the idea of promised money is very difficult because it's very easy to make promises and very hard to keep them. That just makes sense, right? Very easy for corporations to say, hey, come work for us, we'll give you a big pension, and recruit workers. Or for politicians to say, hey, vote for me, I'll give you this, health care, or I'll give you these drugs for free when you get old. Making promises is, again, promises are just easy to make, especially when you have an agenda and you want to recruit the best workers or get elected. And so it's interesting for you to develop your own opinions politically as you actually look at numbers and the lack of functionality that these things have. When you look at fiscal policy, you're saying, this is how I think the money should be. It really comes down to two things: taxes and spending and promises, right? Spending is about keeping promises. Tax is about breaking promises. Read my lips, right? And so, the taxes are climbing, the spending is really going quickly, and the deficit is rising huge. So, what's the equity? Hard to say. It depends on if you believe this number. If you believe this number, let's see, let's add it up. We'd have 156 over here if we believe this number, minus 125 here, minus 22 here. And, you do that math and that would be the number, right? My brain's probably not good enough to do that. That's probably what? 6 minus 5, that's 9, isn't it? I don't know what it is. I think that sounds about right. Because this would be what? 127, and then 156. Yeah, 9. So 9. If you believe that the nation really can count everyone's personal stuff as theirs and can liquidate everything we have, which would basically be a commune, a community, saying, look, this belongs to the community. All this type of stuff, we're communal. And so everyone, has to share with everyone else. And if so, that's the net worth of the community. Not much. And even then, you're still having to deal with this $1 trillion deficit. So you're 9 years from bankruptcy if you were to really pay all your bills and not borrow. So it's a real interesting idea. Where do these taxes come from? Well, the taxes come from the government slice of the GDP. So here is our gross domestic product at 21 trillion, and they take a piece out of that pie. Of course, you say, well, 3.4 trillion, that's not bad. That's just about 15% or something like that. Well, most people don't pay taxes. About half the people do live communally. They say, look, take care of us. And I think that's a good thing. You want to have a safety net. You don't want crime. You want to give people a chance to live so you can have a good society. On the other part of that, though, that's just the federal government. You've got beer tax and cigarette tax, all the sin taxes. You've got gasoline tax. You've got taxes on hotels and travel. You've got taxes. You've got toll bridges. You've got taxes on property. You've got taxes on sales tax. You've got state income tax. There's just that pie. You start listing all those taxes, and understand that every time there's a transaction, it feeds that pie. So if we go into something called a recession, and the pie goes from this big to this big, right now the economy's growing a little bit. It's not growing as fast as this number is, but it's growing a little bit. Maybe it's growing. But the problem is you can't really grow your way out of this problem. We can't grow fast enough. And if we shrink, then that makes that percentage even smaller. It makes this number go down where this number remains. The expense will remain. So that's why people freak out over risk of recession, because what happens is it forces us to borrow even more to maintain a military and to maintain education and the things that are tremendously inefficient run by governments. So that's interesting stuff, right? So let's look at a couple more of those big numbers. The buying power is an interesting number if we bring this back up here, because the Congress decides how much to tax and how much to spend, income and expenses. They control these two numbers, how much we tax people. Wouldn't that be nice to just be able to levy taxes on people that earn money like a king? Just say, look, this is how much money I want to bring in, so this is what you have to pay. That'd be nice, just to have a group of people to vote on how much of everything people have to give or give away. And then they get to choose however they want to spend it, and they get in there and fight and argue about how that should be done. Well, the buying power is interesting. There's something called a debt ceiling. And the debt ceiling is kind of a strange idea because there's, in theory, a limit to what they can spend. In theory, that they can't spend whatever they want, but there's no limit on. I don't think there's a tax ceiling. Maybe there is, but there's no limit on what there's a limit on what they're supposed to do. But every time they hit that limit, and it keeps going from 1 trillion to 2 trillion to 10 trillion to 20 trillion to 22 to 23. Usually about $1 trillion at a time. They'll get on TV and the Republicans and Democrats will fight, and they'll say, well, the Democrats spend too much, so we need to borrow more, and it's their fault. And then the Republicans say, or the Democrats say, well, the Republicans won't tax enough rich people, and so it's their fault, because they don't care about poor people, and they fight and argue, and both of them are wrong, in my opinion. They're all silly. And then they have a big saber rattling thing, and then they say, we're going to have to shut down the government, and you're not going to receive your Social Security check, and that's not true, and they scare each other. And finally, they vote to raise the debt ceiling again, and it starts all over. And so the debt ceiling, while it's supposed to have a ceiling, it really doesn't. They just change it. And they vote to borrow more money. And it's an interesting thing. So you can go to the U.S. debt clock, and you can also get the credit score here. They used to have a AAA rating. This is Standard & Poor's global ratings here, and this is the ratings of many countries. And it's interesting to see. This is just like people and companies. As you have the Congo here where they've got C credit here. You got Costa Rica with P credit. Denmark, AAA. Look at that. AAA rating for Denmark. That is as good as it gets right there. I mean, across the board, they look absolutely fantastic up there in Denmark. So there you go. Let's see if we can find some others that are, we got a lot of B's and, a lot of stuff going on here. Mozambique, don't know what that SD is, to tell you the truth. Never studied that, but don't plan on going to Mozambique. But if you go down to the United States, we don't have a AAA rating. We're close. We have a AAA plus and a AA or a AA plus. This is transfer, convertibility. So we have a AAA in terms of, do we think we'll do business with other countries? And the answer to that's yes. Venezuela not doing well at all. But we lost our AAA rating in 2011 when our deficit hit $1 trillion, and they basically said, "Look, you guys are starting to raise a couple eyebrows, and it's not AAA money." And Alan Greenspan went crazy and said, "Look, we can print money to pay our debts. We don't have to, do this." And so it's an interesting thing to see that crack in this USA AAA rating, because our currency is the world currency. It's how everything's traded. Petrodollars and oil and stuff like that. So it's a real interesting thing. So why does all this matter? Well, it can be brought to bear. That's for sure. Every year there's a government accountability office, and the person who runs the government accountability office is called the Comptroller General of the United States. And so just as a company has a lead accountant called the controller, that person puts together a report and sends it to the SEC every quarter, called that 10Q, or that annual report, which is the 10K. And so the government has an investigative arm called the U.S. Government Accountability Office, and this office's job to hold the government accountable. Now, that really doesn't mean anything to hold someone accountable. It just simply means, hey, you have to give an accounting for what you're doing. There's no penalties. They have no power. But they write a letter every year to this one's addressed to the President of the United States, the President of the Senate, and the Speaker of the House. That's who this is addressed to. And it says the same thing in recent years. And it's fascinating reading for someone like me who digs this stuff. But it says the report on U.S. government consolidated financial statements for fiscal years 2018 and 17 underscores that much work remains to improve the federal financial management. We'll talk about that. And that the federal government continues to face an unsustainable long-term fiscal path. So basically what it's saying is, with the amount of promises it's made, that $125 trillion in promises, and the money it's borrowing, the $22 trillion and climbing, that this is not something that can be sustained. In other words, that we don't produce enough as a country. It's just basically as if I were to come to you and I were saying, look, you're buying too much stuff based on what you do at your job. Maybe you're a dentist. And I say, look, you're working 40, 50 hours a week. You're drilling teeth. I know you're working hard, but the truth of the matter is you don't get to buy a Ferrari, because as a dentist, you don't make enough money to justify a Ferrari and a McLaren and these trips to Paris and all this other stuff. You are living too high on the hog. You take pride that, you're the most prosperous country in the world, so you deserve to have a floor and a television and a cell phone. Well, the people in the Congo don't get that stuff. And for whatever reason, we deserve, what our definition of dignity is different than probably what it is in Venezuela or the Congo. And so it says, look, this isn't going to work. The amount of promises you make, the money you spend on healthcare, the money you spend on defense, this stuff, it's not sustainable. And what's really interesting about this is they've been negotiating with the Department of Defense, because the Department of Defense, to build these guns and planes and bombs and cyber, a lot. I have a family member that deals with cyber warfare, and he gets called up in the middle of the night and has to go fight a cyber war. I guess, I don't know, but it's all top secret stuff, so I don't know much about it. But I know that we spend a lot of money on defense. And what's interesting about this is, for years, the Department of Defense, their books have been so bad that in this report, they've said our confidence in these numbers isn't as good as it could be because their books are not auditable. In other words, there's so much money going back and forth and to this agency and that, and trying to track where all this money's going, that the books are not auditable. Now imagine a company like Apple and their comptroller general reporting to the SEC and saying the books aren't auditable. They would go to prison like so fast, right? I mean, that's Enron type stuff. And the thing that makes you a little bit raising your eyebrows at it is, why are they not auditable? Well, it's either one of two things. Either they're incompetent, which is frightening if your military is incompetent. Either they're just not able to add and subtract. That's really all this is. It's just like your budget. I mean, accounting is addition and subtraction, right? It's not that tough. Okay, we gave you some money. What did you spend it on, and where are the receipts? And they're not auditable. And so that either means that they don't know how to add, or there might be funny business going on. Because when you can't account for things, well, where'd it go? Oh, I don't know. So it had to go in someone's pocket. So that's an interesting thing. So they've been working hard with the Department of Defense to say, hey, can you get your books? And they have like this, from what I've read, they're working with them to bring them in line slowly. Might be a way to put it. But it's fascinating stuff that the fiscal irresponsibility of the most prosperous nation in the world is embarrassing. Not to have a AAA rating, not to have a sound financial plan. It's very, very difficult. And so you can, make your own political, feelings towards it. I'm pretty neutral on this stuff. But the thing I care about is not that it changes. I don't know that it's changeable, but I'll just share my personal opinion is I don't think I can do much as one person to change this. David Walker, a former Comptroller General of the United States, he's one of my heroes. He's tried to change it, but he finally just quit his job in frustration, boxed up his stuff, and now gives speeches on this saying, hey, no one listens to me. And he says this is a problem. But for you and I as investors, from an investing standpoint, if you remove yourself from the political ramifications and your own, moral feelings towards it, you say, look, what's happening and can I prepare? Now, why am I spending so much time on this stuff right here? Well, if you'd like to know how to predict the future, look at policy and look at demographics. And let's talk about how valuable this would be to study. I said at the outset that this course might be the most important class you've taken. If you look back and say, well, learn to read is probably number one. Math is pretty cool, but you do have a calculator to use. But being able to put those things together, this might be one of the most important things that impacts your life. And let's talk about the ability to see the future and the value in that, both financially, but just in peace of mind. We can't predict the future perfectly, but what if you could? It's an interesting thing to think about. It's not just money. Of course, money is a big deal. There's a movie called Back to the Future with a villain named Biff, and they have a time machine that's made out of a DeLorean. Guess what it has? It's got a flux capacitor, man. And a flux capacitor is nice because if you can get that DeLorean up to 88 miles an hour, it'll take you anywhere in the future or the past you want to go. And the villain Biff gets in the DeLorean, and he steals a sports almanac, and he goes back to the past, and he gives himself the future. He gives him all the scores of every major sporting event in the last 20 years, and the future allows him to get rich. He goes to the casino and he bets and makes all this money betting on sports. So that's a big deal. Now, but it also has ramifications beyond just finances, your peace of mind, where are things going. So policy shapes the future. Policy and demographics are what really shape the future. And I tend not to like to talk about religion and politics in a class, so we'll leave those out. But we'll talk about it to this extent and then invite you to think about it through this lens in terms of as demographics change and as policy changes, the future becomes set. So, for example, we had a policy change called a 401k, and that changed the future for a certain demographic of people, right? It changed the future. And I've got podcasts on that. If you want an interesting one, listen to my podcast with Ted Bennett and with Richard Stanger, on the 401k. That's interesting stuff. So we have this group of people, this 79 million baby boomers, this boom of people. They were born at the same time. They went to school at the same time. They went to Woodstock at the same time. Now they're getting out of drug rehabilitation. No, I shouldn't say that. But here you have now, and these people are moving forward in time and getting older. Well, once they hit a certain age, right, this big bubble of people that's going through time hits a certain age, then they are promised a couple of things. They're guaranteed a couple things by the government. They're guaranteed medical care and a basic pension through Social Security. So when these guys hit a certain age, they become pensioners and medical dependents on their fellow citizens, on the U.S. government. And this is where that $125 trillion is at. It's basically medicine and food for older people. And we don't make enough money as a country to keep those promises. It's that basic. And so this is how you can see the future. And this is starting to happen now. I've talked about this for about a decade or so, and here it is. We're hitting this to where this is, 10 years ago we had the cusp here. Now we're really starting to get into it, and the world is changing. So you can see why fundamental analysis on the sovereign level is it's a big deal. It's a big deal. So let's dive into some numbers. And we talked about value and what you pay for things and important numbers. And I will say that we talked about in the corporate world that we had a couple important numbers. We wanted to know how they perform now in terms of what could they produce now in the earnings. Remember this? And then we also wanted to know what they were likely to do in the future. And those were the ones Benjamin Graham really cared about as a value investor, earnings and growth. However, here I would say, in my opinion, it's a little different in sovereign fundamentals. Is I would want to know this: as we draw the financial statement, and we have the income, which is really taxes, and we have the expenditures, which is really spending, right, going out, taxes coming in, and then you have the assets of the country, which was up for debate, right? What are their assets? Is it Mount Rushmore? Is it the Pentagon? You're going to mortgage? You're going to mortgage the White House, right? You're going to go into get a HELOC on the White House, right? And then you have these liabilities, both borrowed, right? Borrowed and promised. Well, if you take the amount they borrow, that's generally what they see as being the debt. If you take the amount they borrow, the question is, how can they pay that off? That's really why they say, in all these reports I've showed you, look, they're on an unsustainable fiscal path because they can't pay their bills, and their borrowing is growing to their ability to pay their bills. So if you track back where all this comes from, and you follow the cash flow backwards, you say, well, where do the taxes come from? And they come from the gross domestic product, right? GDP, gross domestic product. How much money do the people and the corporations and the small businesses make? If this is to grow and do well, then they have a sufficient pile of money to collect taxes from, to pay back these bills. If they don't, it's tough. And just paying the interest on our national debt is becoming a problem. Just the interest to pay to the bondholders. And people say, well, it doesn't matter. We've loaned the money to ourselves. Well, that doesn't make sense. We borrowed the money from ourselves. Well, these people that hold these bonds, they want the money back. This idea that we borrowed it from ourselves, well, that doesn't mean we don't need to pay it back. The individual, if I buy a U.S. bond, treasury bond, I want to get paid back. I want that interest. So this idea that we borrowed it from ourselves, I don't know who came up with that, but well, yeah, sure, but I still want the money back. For my own personal financial statement, I care about it. So it's a big deal. And so we have these two numbers here. We have the debt, right? And we have the GDP. So that'd be an interesting number. What is the ratio between the debt and the gross domestic product? And that would be an interesting ratio. Look at those numbers. How much debt do they have, and how much GDP do we have we could tax to pay it off? And I'll give you some context on this if you'd like. If you look at debt and GDP, if you look at, for example, the Eurozone, right, where they decided to get rid of the German mark and the French franc, I guess they had them over there. In France, they had the franc. In Germany, they had the mark. Of course, the UK decided to keep the pound. The Czech Republic kept their currency. Poland kept the zloty. Switzerland kept the franc. But most of them went to the euro. And to be a member of that Eurozone and go under one monetary policy, because it's really interesting, because in the U.S., let's look at the U.S., for example. The U.S., you have fiscal policy, which, is the balance sheet, and you also have monetary policy, which is the Fed of printing money, and we'll talk about that. So we control the fiscal and the monetary, right? Fiscal and monetary. But here's what's really interesting. In the Eurozone, you have all kinds of financial statements. You got one from Germany, you got one from Greece, you got from Italy, you got one from France, right? You have probably 19 different financial statements of different countries flying their flag, but then you have this one central European central bank. So if Greece starts to screw up and borrow too much and spend too much, it can hurt that euro if they have to print them. And so Germany's saying, hey, what are you doing? Because we like austerity. We went through the Weimar Republic. We know how bad this gets. So you have countries that kind of put pressure on each other, like Greece and Germany are not friends. because every time Greece is crying for money, Germany says, well, what are we getting out of this? So it really creates an interesting political environment. But when they formed that Eurozone, to give you that context I mentioned, when they formed that Eurozone, I believe you had to have a debt to GDP ratio of 60%. In other words, you couldn't have, 1-to-1 for, it was 60%. They said, look, we can deal with it if your debt is 60% of your GDP, which is an outrageous number. I mean, try to go get a house with a debt to income ratio of 60%. Go try to get a mortgage, like that. Go try to borrow money to get a car with a debt to income ratio of 60%. It's just an insane thing. I don't think there's one country. We should look at this. I don't think there's one country. If we look up let's do that quick. Go something like that. So, expand this statistic. Let's expand this. So Greece is at 181, right? And really, you have very few of these guys that are fiscally responsible. Most of the big ones, Germany's in that 60 still. But this is interesting. Here is the national debt in relation to their GDP. And so, you have the whole EU here at about 80, 85-ish. United Kingdom at 85-ish. But you have, Greece, Italy, Portugal, Spain, France. A lot of these are getting over 100%. It's an interesting stuff to look at here for sure. So the Eurozone is very much printing money right now. Very, very, very much printing money. And the United States is also, a pretty big country. Japan is the one that's just completely out of control on this type of stuff. When you look at Japan, their debt to GDP is 235%. And I remember I was kicking myself for not shorting the yen, and George Soros did. He made a couple $1 billion doing it. As I was actually over in Japan, and somehow they had this English newspaper, and they were saying that the central bank of Japan had an inflation target of 3%. And, in other words, their goal was to reduce their value of their currency by 3%. China, as you look at how they rattle their sabers in a tariff war, well, how do they fight a tariff war? They say, well, we'll just, reduce our currency and make our exports more attractive because they're, cheaper. And so it really works when you reduce the currency. And yet you can't do it too much, or they just take it to Zimbabwe proportions. So there's a balance of this stuff, and it's very much about currency, very much about bonds, very much about their ability to keep their promises to the people that they make them to. So as this debt, you look at different countries. We saw Greece. We just have to update because we just got the data. Greece is at 181. So it's like it moves so fast you can't even build a slide to keep it. But as these countries, get more and more debt, it does put pressure. And one of the ways that this is helpful to look at is insurance. In other words, how can you tell how much risk there is? Well, one way you can do it is we mentioned those AAA ratings, right? And these ratings, but I got to tell you, in the subprime meltdown, like Moody's had a lot of these bonds rated as investment quality bonds, and it didn't work that way. And the S&P, this is just a bunch of guys' opinion. The guys that I would trust even more, I can't get that solid here. The guys that I would trust even more, don't know why that's not flying for us. The people I would trust even more than Standard & Poor's would be the insurance companies, and I'll tell you why. When you have massive debt like this, okay, and you have bonds, what you can do is you can insure your bonds. In other words, you can buy insurance in case they default. And so they call this a swap. They call it a credit default swap. So in other words, if they were to default, you've extended them your credit. If they were to default, you would get remunerated for that. It's an insurance policy basically on debt. Well, think about how insurance works. Those guys are pretty good with actuarial tables. They're pretty good with probabilities. And they're pretty good about knowing what premium to charge. And so if I see your insurance premiums are really, really high, that tells me something about how they feel about your health. For example, driving record. If your insurance is higher than me, then that means you probably have more speeding tickets. You might have a faster car. You might be a different age, where they say, look, based on what we know about these things, we're going to charge these guys more for insurance. So one of the things you can keep your eye on is credit default swaps, how much they charge to insure the debt. Here's an older one that shows where we were really in a tough spot, and you could see over time that Greece had these huge spreads in percentage points in the credit default swap as their debt to GDP started to grow and get bigger and bigger and bigger. And so this is really interesting data. You can get this on websites and CNBC, and you can that'd be a fun homework assignment to say, let's go find how much it costs to insure Grecian debt or Venezuelan debt or even European debt, right, or of different places, Spain, Portugal, Japanese debt. What are the risks according to the insurance company? So I love to watch the credit default swaps, because if the insurance go up, they call them CDSs, if the insurance goes up, that tells me there's more risk in those countries to be brought to bear. As you look at the U.S. debt to GDP trend, it's going to get, they say 141 in 2046. That's a pretty mild projection compared to what comes out every single year on this particular chart. It seems to get higher and higher all the time. You can read that GAO report or the Congressional Budget Office report. This is the type of stuff investors read and want to stay abreast on. So fiscal policy is taxes and spending. That's the first policy. Policy and demographics give us the future. So we've talked a lot about fiscal policy, the United States, the Eurozone, Japan a little bit. And those fiscal policies really determine a country's fate, just like your policy personally determines your fate. At the beginning of this course, I invited you to keep track of 8 numbers, manage 8 numbers, and set goals for 8 numbers. How do you do that? Well, you do that with policy. What's my education policy? What's my spending policy, right? You have the same decisions to make as a country or a corporation. How much money do I want to spend? What do I want to invest my money in? What's a policy? How often am I going to have a meeting about this? That is a corporate policy, right? How often does the CFO meet with the board? That's part of the corporate policy. We send a 10Q into the government to account for things. Well, where's your accounting policy? The GEO sends a brief every year to the Congress. The comptroller of companies send a thing every quarter to the SEC. Where are you accountable to your bookkeeper and your accountant? Do you have meetings on the calendar to run this stuff properly? A lot of people bash the government and say, oh, they're out of control. And if I were to say, well, what's your fiscal policy? Where's your financial standing? How do you do things different and better than the government? So you have policy that shapes the future. I can't say it enough. Policy and how you structure your life and the rules you decide to follow, these policies shape how the future will be. The future's in your hands. So in the United States, where I live, and it's the same with the European Central Bank or the Central Bank of Japan or China's bank, they set monetary policy, and there's a few things they do. They set the rate, the discount rate they call it, for short-term loans, and they print money. And there's various ways they do that. In the first version of the 4 pillars, I went into this probably too much detail, too wonky. In what they do, they set the fractional reserve lending and credit and extending credit. Now I'm going to let you read books from like G. Edward Griffin and The Creature from Jekyll Island and others. There's a little bit of conspiracy feel to some of that stuff, but there's also a lot of truth to it. And I will say that policy, does affect markets. You can look at places that are very important in charts, and you can see, bearishness turning into bullishness and growth and decline based on the Fed's major bank actions here. If we were to put this in theater mode, we can see it slightly better. But here we had the subprime meltdown. We'll just call that the subprime meltdown in 07 and 08. And all those collateralized debt obligations and all that stuff in the Big Short happened. And the Federal Reserve said, we're going to purchase $600 billion in agency-backed mortgage securities, mortgage-backed securities. So in other words, these collateralized debt obligations were backed by mortgages. So these were securities where the collateral was a mortgage and the mortgages were going bad. So it was basically a bad asset. The mortgages that backed these securities were failing. And so they said, look, rather than having the banks absorb this $600 billion in bad debt, that would put the banks out of business, we'll buy them and we'll absorb that bad debt. Isn't that interesting? So it can magically go away because the Federal Reserve doesn't care if, well, it probably should, but the Federal Reserve will take on those bad loans, those bad assets. And what's amazing is the $600 billion they paid for these loans, they printed out of nothing. So think about that for a minute. Here these banks have all these bad securities that are backed by this bad debt, and they're going to go bad, and they're going bad, and people are getting foreclosed on, and it's just this big freaking mess. So they say, look, we'll give you top dollar for this stuff. We'll just give you the money, and you can sell them to us. And so the banks just get out scot-free, man. Amazing. They just said, look, that'd be like you saying, I bought Enron, and Enron went down, and it's going to go down further. They said, we'll buy your Enron from you, and we'll absorb that loss, knowing they were very risky and very bad investments. So that helps the banks. In 2008, at the height of the crisis, the Federal Open Market Committee, called the FOMC, sometimes I call it the FMOC, but it's the FOMC, decided to lower the interest rates to zero. So now, not only are they buying this stuff from banks, but they're loaning the money with no interest on it. I mean, you can really do a lot of cool stuff if you can borrow money for free. Pretty amazing stuff. On November 3rd, they started having this pullback here. And when they got up to resistance, you can see, when they got back up to resistance, they wanted to push through that resistance point. And so on November 3rd, the Fed announced that it would purchase another $600 billion of longer-dated treasuries at the 75. And we sometimes call this stuff Operation Twist, where they swap times. Plan to purchase $400 billion of bonds. More twist stuff. You've got Operation on September 13th. Now they go completely crazy. And look at the market on this one. It's interesting technically that I said, I said over and over, I said, just technically, I says, we got to really watch this level because this is major resistance, right? This is the most we've ever paid. This is major resistance. And I said, notice this rising wedge. Let's start getting into technical analysis. That's our next pillar anyway. But this is a huge burst, smaller burst, yet a smaller burst, and yet an even smaller burst. So we see the energy in the burst getting smaller. We call this pattern a rising wedge. That it's just harder for it to have a huge burst with each thing. So they say, well, what can we really do to give it some juice here to really send it? What can we do? How about open-ended commitments for $40 billion of these mortgage-backed securities every single month? How about that? How about we take all that debt off those books there? Bam. I mean, for years. And these Fed actions, in my opinion, have created what was the greatest run in the history of the market. It was policy. And there's a saying that says, don't fight the Fed. Don't fight the Fed. No matter how horrible your outlook on the fiscal policy is, monetary policy, came to the quote-unquote rescue, but at what cost? We printed. I mean, if you start adding this money up that we're printing, right? Adding all this money up that we're printing, this is in the trillions of dollars here. So we have a pullback here, and the Eurozone goes crazy here, and the ECB starts doing stuff. Well, down here, if we were to catch this up, we went to what we call patience. We started raising rates here when it started to fall. And what's interesting about this December right here on this chart, it's a bigger candle than any one we have. It's the worst month in the market we've had in this 20-year period, probably ever. And this was halted when the Fed said, all right, we're going to quit raising rates, trying to reload our gun. We'll do what's called patience. And they've been accommodating ever since. That's a kind of an older chart. It's not updated quite yet, but you get the point. And the point is that this stuff matters, right? So we're coming up close to an hour. What I think I'll do is I think I'll put a splice in right here. And when we resume, we're going to be talking about what it means to print money and what money is and more about monetary policy. So make sure, get with your coaches if you haven't had a coaching session in your coaching group. Maybe run some searches for information on credit default swaps. Start getting comfortable with debt to GDP. And when we come back, we'll talk about challenges with printing money and currency.